lecture number 8, evaluation of investment in engineering projects. What we are going to do is to apply all the basic knowledge we have acquired in the previous lecture about time value of money, about the different equivalent formulas for different scenarios, like now calculating the present value or future value or annual payments, and in different situations. So those were basic problems, and now what are going to learn is to apply those basic concepts in big and complex problems, like any engineering or infrastructure company experience in their everyday operations. They are assessing investments, and then what are going to learn is the different methodologies those companies use for evaluating their and assessing their investment. So let's talk about the general framework. This is the target of this lecture. Lecture number 8 is the general framework of business analysis in engineering projects. As usual, the recommended textbook for this course is the Chance Spark from Pearson Education, Engineering Fundamentals of Engineering Economics. Let's start with a real case of a telecom company, American telecom company, very well known, which is Verizon. Verizon is the first or the second operator in the United States. The first one or the second one is AT&T, and then Verizon. So let's analyze the main challenging project Verizon experience nowadays. This project is the project FiOS. Is fiber optic investments, and they want to create their future new network, which will be based on fiber optics. As you know, fiber optics networks have the main characteristic and advantage of fiber optic networks is the huge bandwidth you can get from your internet connection. So due to that, benefit of that, you can have triple play services like, of course, voice, fast and super fast broadband. We are talking about the speeds of 100 megabits per second. And then the third service is TV services. TV services, not the conventional or the standard TV services we have today, but we are talking about high definition TV, and not only watching one HD channel in your TV, but watching several HD channels in several receivers in your home. So that huge amount of information travels by the fiber optic access you have in your house. So what is planning and deploying Verizon is the FiOS service. It's a fiber optic service, as their letter explain. FiOS is and this project is a big investment project. As we see here, we have some data from Verizon. The first one is the level of investment. It's a very huge investment project. Let me use the pen. Okay, this project implies $23 billion in investment. Billions are the 1,000 in Europe. So we are talking about 23,000 millions of dollars that will be invested along for several years in several cities and towns, and they have to make civil works in the streets and to lie the cable, the fiber optic cable, and accessing to every building with fiber and so on. And does make sense this project from the point of view of economics? So that question can be solved, can be answered by our knowledge and the knowledge we are going to develop in the next lectures. So this is the main usefulness of engineering economics, analyzing this kind of project. If a telecom company, in the case we have chosen, plan to invest $23 billion over 5 or 6 years, and then in the future this investment will be transformed in a fiber optic network, and over that fiber optic network, this company Verizon will supply new services like fast super high broadband of 100 or 200 or 300 megabits per second, and as I have told before, HD TV services and so on. So as Verizon explained, this is a triple play of television, phone, and online and internet. And they say, Verizon explain us that this service, Fios, is profitable. What does it mean that Fios, Verizon, have studied this investment in terms of engineering economics, and they have learned, they have known that this project, this investment project, is profitable. So why this project is profitable? Because they say that, for example, they can, with this network, double the amount of video customers. So if they have now 100 as an index number of TV customers, they will have with this network, due to the enrichment of the TV services, they will provide this network, they will double this number, so they will have 200 as an index number over the next 2 to 3 years. So this implies that this network will generate new revenues streams for Verizon. And they say also this network, these new services, gets interesting margins for them. So the margins of the price and the cost, including the capital expenditures, those margins, prices minus the cost, creates interesting margins for Verizon. So as they say, in the first quarter of 2010, the overall company margins boost. So it means they increase it a lot. And they say that new these Fios services contributed to 53% of consumer revenues in the fourth quarter. So let's talk about the economics. And a Verizon spokesman says that the fiber investment create cash flow positive a few years ago in 2008. So that means that if you have cash flows which are positive, you don't need to finance those cash flows, those operations. So this is good news for the company to have cash flow positive. And they say that those cash flows are higher in the Fios initiative than in the traditional wireline segment. So this is quite interesting. So at the end, what Verizon is telling us, that Fios has a positive present value and generates returns on invested capital. What does it mean? That Fios is attractive for the investors. It's a project interesting and attractive for the investors. Why? And they use a technical word, a technical term we are going to understand and to know today, which is the present value. We know that concept. We have studied in the time value of money. We have studied in the equivalence formulas for interest. We know what is the present value. And then they say that it will generate returns on the capital invested. It means that they have put, for example, 1,000, and then they have returned 200, so they have a return of 200 divided by 1,000. It's a return on their capital invested, which is 1,000. They have a return of 20%. So that's the kind of thing we are going to learn today. But this is not all the positive things, because this is what Verizon tell us. But there are skeptic on those numbers. There are analysts, financial analysts, who are studying the numbers, the financials, and the economics of this investment project, and they think that this investment project is not a good investment project. So their main argument is that investment in fiber optic network is not a good business because it hasn't a positive net present value. So we are talking again about engineering economics. They say, for example, that this analyst, Sanford C. Bernstein, says that the FiOS service doesn't return any profit for Verizon. So they say that building new networks is a losing proposition. So they say that creating new networks is losing your money. And they give their arguments. Bernstein, this guy from Bernstein, Craig Moffett, gives us about several numbers. He said that this project will cost Verizon per connected home a figure of $4,000. So creating this new network implies investing per a new home which is connected $4,000. And then he continues his arguments and say that if we calculate, and Moffett has done, the present value of the new customer, and he said that the present value of the revenues, of the future revenues of this customer, and the cost of this customer, of providing services to that customer, the present value is $3,200. So as you see, the invested amount is 4,000. Sorry, you don't see here, is 4,000. And the net revenues, I mean by net revenues, we are going to see in the next slide, revenues minus costs of $3,200. So as you see, the invested amount is higher than the present value of the net revenues, which are lower. So they say that FiOS has a negative $800 net present value per customer. So how this Moffett analyst, this man Moffett, has reached those numbers? Because he has used engineering economics. And there are other critics about this project. You can read yourself and then having your own conclusions. So, have you got any question? Marina, Alejandra, and Ignacio? Okay. Do when you want. Then next slide is the objectives of this business investment analysis is to decide about the financial risk when a company invests in new long-term assets. So For example, the Fios fiber optic network is an asset. It's a long term because you deploy for 20 or more years, and then you expect to return along those 20 years. So why is important to do this business analysis? It's important because the investment a company makes today determines its future successes. So if Verizon today, Verizon does not invest in that network, fiber network, in the next 3 or 4 years, another companies will do, and Verizon will not be ready for providing new services. So that's the reason it is important for companies to invest. And of course, to invest requires detailed analysis and careful analysis. So all the engineering-based companies, like a telecom operator, like a energy company, utility, or so on, all of them, they have a lot of projects. They are studying always new projects, new investment, and they need a tool, a methodology, or different methodologies to apply to the different projects and to select only the best projects in terms of their financial numbers. So that's the reason of the importance of the very high importance of these projects. So any organization, as a conclusion, needs to establish procedures for screening projects to ensure that the right investments are made. What is a screening project? We are going to see now. But a screening project is you have several projects and you focus your attention just in a small part of the project, basic information, and then you can pre-select projects and discard and reject some of the project and accept other projects to go ahead with further analysis. So this is screening. It's a common business. So this is a taxonomy of different project screening methods. We have 2 main classifications. One is non-time based methodologies, and the other one is time based. Non-time based are very basic methodologies, and that's the reason we use non-time based as a screening methodology to reject projects as an early with just a small work. You can decide rejecting projects. The different methods based on non-time are the payback period. Other one is the discounted payback period. And what is the payback period? The idea is to have the net cash flow of every year of the project. Net cash flow is inflows minus outflows, revenues minus cost or expenses. So we have this net cash flow for every period, and then we calculate when the cumulative sum of those cash flows over the time makes this number, the cumulative net cash flow, positive. So it gives you an idea of how long your project is in negative cash flow, and then if this project is in negative cash flow, you need to finance this project. You need to go for the shareholders' money, or going to a bank, or for having debt or loan, or so on. The other alternative, what happened with the non-time based? That, as we know, it's very important to introduce time value of money. So in any business analysis. So the main drawback of the non-time based methodologies is that they are not based on time value of money, which is the most essential rule for evaluating in terms of financial interest different projects. So the other methodologies are the most used, are the time based. The most used and the most known is the discounted cash flow. This one is the net present value. we will calculate a number, which is the net present value, and also another number if the internal rate of return of the project. So this is the best methodology and the most used methodology to assess investment project. Another methodology used in specific context is the annual equivalent worth, and the other is the benefit cost, which are used in some specific areas. For example, benefit cost is used in the area of public administrations project, because the concept of revenues is not clear in the public administration. So we have to calculate the concept, more general concept of benefits for citizens. And the annual equivalent worth is another methodology used to compare projects with different structure in terms of capex, in terms of project life, and so on. So you need to have a common measure of the project, and then this common measure is the annual equivalent worth. So as I have said, the most preferred and used methodology is the discounted cash flows. Discounted cash flow. Let's talk briefly about the project cash flows. What are the project cash flows in general in a business company, in an investment project, in an engineering company? We see over the time the different cash flows of a project. What are the main cash flows? The main cash flows, as you know, we call the positive cash flows are the inflows, we call them inflows, and the negative ones are the outflows. So what we are seeing, what we are taking into account is that a project is like a black box, and then you have money incoming to the project, money inflows, revenues or something like that, and then you have outflows. You have money you have to pay to the providers of production factors. So those are the outflows. The main categories of cash flows are, as you see here in the slide, are the capex. The capex is the initial investment. Capex is capital expenditure, is expenditure of in capital assets, in capital projects, in capital products. An asset, a fixed asset, is, for example, a new machine, a new network. So it's a product you bought, and then you modify or you construct with this asset, and then it is expected that you use this new asset, and this new asset will allow you to generate revenues. So that is a capital expenditure. So a capital expenditure, having in mind this black box, is an outflow, capex. It's money you have to pay to the capex providers, to the different companies selling you the assets. In the example we have used here, we have a project cash flows, and then we have two different period of time that you invest money. In T0, in the first start of the project, you invest 3,000 millions or 3 millions. The figures are in thousands, so 3 million euros. And then in the next year, in the period T equal to 1, you invest another 2 million euros. So as you see, we see here the project cash flow. In the diagram, we use the minus sign to indicate that this to show that this is an outflow. And we have also this other basic information of a project is this table. We write here in the first column, we write the period of times from 0 to the project life. In this case, the project life is 10 years. We write here to clarify the different streams flows. First one is the CapEx. You see here in year 0, in time 0, time 1, time 2, 3 million, 2 million, and 1 million. And you see here also in diagram the third period of time. And then after investing those CapEx, you start to generate revenues. If we think revenues is bills that we send to the customer for using these products or for using these services, and then those revenues, when they are paid by the customer, we have receivables, what we call the money we coming into our cash, and then this is the inflows, and this is the receivables. Sometimes you generate a new sale to a customer, and then you pay. You send him a bill, and then in the next month he will be paying this bill, and then this is the concept of receivable, and then what we have to compute is real cash flows, real amount coming into our cash of the project. So those are inflows, and we have the cost, the different cost, and then of course also associated to the cost are the payments of those costs, which are outflows. So you see here the table with the revenues, the inflows, and the outflows in terms of cost, and then the net cash flow will be the sum of those cash flows for every time, for every period. No? As you see here, we have revenues, selling units are 1,000 with a unitary price of 250 euros, and then this increase, the units sold every year increasing 10%, so you can generate by yourself this table, starting with 250 and 800 and 1,000, and then for the following years you will increase the units sold in 10%. And then the cost, we assume that we have a margin or a cost of 35% of the sales, so a margin of 65. Then you create that, and then this is the project cash flow of any investment. You have invested this amount. This allows you to generate revenues, and then those revenues, they have associated cost, and then we use not the concept of revenue or cost, we use the real cash movements like receipts and payments. Any question? Okay. Here is a summary of the previous concept. You can read by yourself. For example, let me emphasize the concept of, for example, these different kinds of receipts. You can have upfront payment, subscription amounts that you only have in the moment a new customer arrives. And then also you can have monthly payments, or in the case of services, also you have salvage values. What are salvage values? Are receipts that you can earn when you have an asset, and then you want to end this project, to finish this project, and then this asset it has enough life, it's not consumed, it's life. So for example, you can use another 3 or 4 years more because this asset is not exhausted. So you can sell this asset in the second-hand market, and then this price, this revenue you will have for selling this asset that can be used. This is the salvage value. And outflows are payments that we have derived or associated with cost or expenses, either with vendors or suppliers of products, or operating expenditure, OPEX, what we call OPEX as an important concept, like personnel, general selling and administration, SG&A, or operation and maintenance contract, leases, energy, and so on. Any question? Okay. And then let's talk about what is a capital investment project. A capital investment project is a company that invest certain capex and expect over the life of the project to get some receipts and some payments. And then, as I have told before, you have net cash flows. Net cash flows are the sum of those concepts, having into account that capex is negative and payments is also negative. So and receipts are positive. So, for example, for this year period 1, we have minus 100 plus 0 is minus 100. And this year, for example, period 2, we have 220 positive, and then minus 88. So you subtract those amounts, and this is 132. So what is a capital investment project is the matter of determining whether the project net cash flows are sufficient attractive to invest funds in the project. So that is the main target of a capital investment project, to analyze if the net cash flows are sufficient attractive to invest funds in this project. Which funds? Those one, the capex. So the net cash flows are equal to the cash inlays minus the cash outlays. This is equal to receipts minus capex minus payments. So this is the basic of defining a capital investment project. And we have ended with the lecture number 8.